is mean reversion? Mean reversion is a theory used in finance that suggests that asset prices and historical returns will eventually revert to the long-run mean or average level of the entire data set. But what I mean by RSI, mean reversion, is that the RSI will be expected to move back from extreme levels, and when I say extreme levels, I mean the overbought and the oversold, to mean levels or average levels, normal levels, you can call that, like the 50%, for example, or any area that is not overbought or oversold, the 40, the 60. So after the price, the curve of the RSI moves into overbought and oversold, it will be expected to move back to normal levels, and that is mean reversion. Now let me take you step by step into the world of this very simple yet very strong technique. First of all, we have to find an overbought or oversold situation. And then, number two, we have to wait for the candle close to see if it's accompanied by the RSI moving out of the extreme area in question. And this is very important. We do not make a move until the RSI itself moves out of the extreme area. Okay, so if we are in an oversold position, the price also drops, and then it starts rising again. No matter what kind of close on the candle we have, if the RSI at that close is still inside the oversold area, we do not take any position. We wait until the RSI comes out of the area, and you will see that with examples. I have prepared some examples for you to make this extremely clear. And number three, we open our positions when the RSI moves out of the area, and we target for this position a limit between the moving average 35 and moving average 49 at the time of reaching the bottom. Let's see how we can use that technique. Examples will make it even more obvious. It is simple, but with examples it will be even more obvious. Okay, this is an example. We are talking about the euro for our chart, and of course this is the recent chart updated this morning. As I told you, I always like to give you fresh charts. No old charts in my seminars, webinars, videocast, training, nothing. I always give you the fresh charts so you feel related to the market all the time. Okay, let's see how this technique is used. First of all, look at number one at the RSI. We got in after the drop of these candles here, we got in. We were not very far from the oversold, but we got in again here. Okay, we got here in, and the price dropped, and not a lot of action around here. We do not do nothing here. We don't care if this is a green candle, a red candle. We don't care what kind of close we have here until the price moves out of the RSI oversold zone. And when the RSI moves away and out from this zone, here at number two, we go long. And as you can see, this accompanies this price area, very low, very good entry, and we got in here and we see the price starts rising up and up and up. 3 green candles in a row, making us some kind of profit. Okay, now where should be the target? Well, I will give you 2 options and I will tell you which one I prefer. The first option is the area between the the area between the moving average 35 and 49 when the price reaches there. The price reaches there around these candles, so this should be our target area. Any place between these 2 moving averages is a good enough target. But to me, I prefer to take the moving average level, not when the price reaches it, but when the bottom was witnessed. And this is the bottom that we have started rising from. And when the RSI and the price were at this bottom, this was the area of target. And you see it is a bit above this area. So we have a bigger target if we use this option when it comes to setting the target. And to me, this is the option that I use. I prefer to place my limit around this area. And as you can see, the price did push past the 49 curve, but it almost touched, let's say, the 49 SMA if we calculate that when the price reached its bottom. Okay, another case we have seen on the euro recently was seen last week when the Fed cut the rates and the euro dropped, which is against the expectation, because the logic is that when currency gets a rate cut, then it should not go up, it should go down. But that was not what happened last week. The dollar went up a little bit and convinced a lot of people that it's going up before obeying the logic of the rate cut and getting weaker. So the situation happened during the Fed rate cut. First of all, the RSI curve dropped with the price and got into the oversold. We do nothing here, we do nothing here. Once the curve of the RSI goes up and out of the oversold area, we start moving higher on the price, and that is the best place to get in, just when the RSI gets out of the oversold area. And as you can see, you don't need me to point out this. As you can see, just when the price moved higher out of this area, a very strong move to the upside followed. Where is our target? Of course, it can be here, or it can be a little higher here. You can, if this is a chart, this is a picture, unfortunately. If this was a chart, we can draw a trend line here and see what kind of level around 1150 is our target. More examples. And with this example, I really want to say something, and that is, in order to estimate what kind of target you should expect, or this technique can give you, you need to look to the moving averages and ask yourself this simple question: how far is the moving average from the current price levels? If it's very close, then it may be better to make this chance go and look for chances where the distance between the current price level and the moving average is larger, because they give us a larger potential of profit. First case on the chart, we got in the oversold, we got out. Once we get out around here, we buy, and you can see this is a target, or this is a target. This is a target. This is my target, and not this. This is my target. Okay, which is, as I told you, it is the moving average area above the bottom, not at the time of reaching this area, but above the bottom. Another case here, but here I want to go back to the target discussion. If we wait until this candle close, we are already at the moving average. So what are we aiming for here? Maybe, I don't know, 20 pips, something like that, between here and here. That's not a lot of profit. So it is up to you, of course. Do you want to get in here? If you want to use this technique, getting in here is not very attractive. I know that the price dropped, but getting in here is not very attractive, because we have reached the moving average so quickly, and it can survive. If the price survived at this moving average, our sell position will not be working out for us at all. We have the same situation here. The difference between, or the distance between the current price and the moving average is not very far, it's very close, and that's why this target is not very attractive. So you may want to skip this, just like we skipped this, and you see here that skipping it was the right decision. Sometimes skipping it, of course, you will miss out, but sometimes skipping it will be the right decision, and this is the case most of the time. Because the distance is not very far, then I don't want to sell here and just look for like 20 pips or something like that, because remember, we have spread and we have fast move, and even if we make 20 pips, who knows if we will be able to close in time in order to harvest these gains, or if the price will move quicker than our ability. That's why we should always target larger targets. Okay, here we have another situation where the price touched the 70. You see, it's not really inside, it touched it and moved out. This is a variation of the technique. I prefer it if the price goes in and out, but of course, touching 70 is oversold. When the price touches 70, 71, that's it, that's enough. When it goes out of there, it is time to short according to this, and our target will be here. See, it's not here. Remember, it is not here. It's not when the price reaches the moving average. It is the moving average when reaching the top or bottom. So this is our target and not this. And this gives us room to achieve more profit. Nick, thank you very much, bro. I really appreciate your feedback. Very useful information. You made my day with this comment. And of course, it is useful because I came to know these kind of things after years of experience, after losses and profits. You know, sometimes I lost money, sometimes I made money, but I love the saying, when you lose, don't lose the lesson. So after all these years, whenever I suffered a loss, I went back to the chart and to my account and to look at the reasons behind the loss. Why did I lose? And I've learned a lesson almost every time, and I'm giving you guys these lessons for free. You are saving yourself years that you need to get this kind of experience when you are listening to somebody who made profit, who made loss over many years, and from every situation he gained a little bit of knowledge. Thank you, Nick, very much. Thank you. And I got distracted with the comments, so we forgot talking about the last case on this chart before moving to the last chart of the examples. You can see that the price dropped from our last situation, and it continued dropping until we went back to the oversold areas again. But look at what happens this time. The price moves inside the oversold 1 and 2 times, trying to overcome the 30% level, and it fails twice, and it stays inside the oversold. Look what happens to the price while it is inside the oversold area. The price keeps going lower and lower. So if you take a premature long position, you would be in loss. We do not take long positions until the price comes out of the oversold area. And we have this finally, after some time, we have this here, not here, not here, not here, here. We come out of the area around here, so we can buy around here with this green candle. If we are lucky to get a price closer to the lower end of this candle, that would be great. And the price fluctuates a little. It gives us some hard time, makes us fear for our money here. You start thinking, oh, what if the price continues going lower? And then the RSI gives you the final word, and it starts moving higher in a strong way, and the price had no choice but to move higher with the RSI and to achieve amazing profit. Our target for this, if we were trading this I would buy at the close, of course, the first close when the price, when the RSI moves out of the oversold area. And this is this candle. This candle closed around 1404, maybe 1405, in the middle between them. If we buy at 1405, for example, the target should be the moving average area just above the bottom. And this is between 21 and 23 probably. So you can see what kind of potential this has. We buy at 1405, we target 1422 or 23. That's 170 to 180 pips. And that is an amazing target. This is what I was talking about when I told you that you need to check what kind of distance we have between current price and moving average. If it's very close, that's not a very exciting trade. But if the distance is good enough for us, this is like 170, 180 pips between the current price level and the moving average area. This is an exciting trade, and of course the market showed us that it is an exciting trade. More examples. This is the euro yen, and we have many examples. I just wanted you to check out these examples. Sometimes it takes a little bit of time for the price to follow the move. For example, here we got out of the area here, around here. Okay, this is with this close, so we sell here, but the price was boring for 4, 5, 6 hours, and then it started falling. We are here in profit. It got a little bit more boring here, and then started falling again. Of course, our target for this trade was not very big, so with reaching these levels, we should have reached the target and got out of the market. Here we have another situation which I will use to show you why I always recommend protecting profit. This is a very good case. That it has all the needed criteria for this technique to be implemented. The price dropped, the RSI dropped, we were in oversold, we started moving higher, and the price followed, of course, and we got in here just when the RSI got out of the area. We got here, buy, great, we have 2, 3 green candles, we are in profit, and we are targeting this area, but the price gave us profit. It did give us profit, but it did not give us our target. So this move has made us profit, but did not reach its target. If we did not move our stop to the profit zone, the price would have dropped and stopped us out with a loss. But why do we give the market the chance to do so? I don't. I recommend you don't. Once we got this very good candle, I move the stop to the profit. On profit of 5 pips or 10 pips, the price goes up, and I'm happy. Okay, I'm great. My trade is in 40, 30 pips of profit. My stop is at 10 pips of profit. That's an amazing situation to be in, because the worst thing that can happen to you now is to make a profit of 10 pips, which is very good. The price starts falling, I don't care. I get out on the stop with 10 pips of profit and look for another chance to go in the market. Here, we have talked about this in the previous chart, but I like to highlight it once again. Just because the RSI is inside the oversold zone, it's no reason to go long. Look at this. If you bought here, you will be suffering losses here. But if you waited for the price to get out of this area, then you will have this small profit. Okay? And by moving the stop to the profit zone, you will be protected from the drop that follows. Here, this is another attempt to recover, and it does not do very well, but of course we have some profit here, but it's not reaching the target. Another example why you should always protect your profit. Once you get into 30, 40 profit on your trade, you move the stop from a loss of 50 or 60 pips to a profit of 5 or 10 pips.